Now, are you somebody who's about to prepare your personal property tax return? If so, make sure that you watch this video so that you avoid the top 8 costly mistakes on your personal tax return. So the first thing that we want to understand is all the different costs that you can claim for. Now, first of all, did you know that there is actually a property income tax allowance of £1,000 gross? So what this actually means is you can earn £1,000 before you have to pay any tax on property income that you receive within a set tax year. Now, the second area that you really want to pay a lot of attention to is repairs, because there are some property repairs that can be deducted from your personal tax return, and there are others where you cannot. So if you take a look at the Property Income Manual, otherwise known as the PIM, that does outline some of those costs that are applicable. But if you don't have a look at this in a great amount of detail, then there might have been repairs that you've undertaken in a year that you've not claimed for on your personal tax return, leading to a higher amount of tax that you're going to have to pay on the personal tax return. Now, another area that you might be making some very costly mistakes on is interest, because historically landlords were able to deduct interest charges from their personal tax returns. However, that was phased out by the government in 2020. And so currently on the likes of residential property, you're not allowed to claim the interest that you've been charged in a year on a mortgage, for example. However, there are different rules for the likes of furnished holiday lets, for example, or commercial building investments. So it's definitely worth having a look into the guidance around commercial buildings and furnished holiday lets, because again, those tax rules are different in some cases. And where you're able to claim for loan interest and other financial costs on your personal tax return, then that again is going to reduce the overall tax that you've got to pay on that personal tax return. Now, tip number 4 is, did you know that you can claim capital allowances on furnished holiday lets? Now, it's definitely worth having a look at the guidance behind furnished holiday lettings, because if there are capital gains tax reliefs that you can claim, then that's going to reduce your overall tax bill. Now, tip number 5 is make sure that you are claiming for all costs that you are able to claim. So the likes of travel costs, so mileage rates, use of home, food costs while out on business, home furniture costs is another one. So if you're looking to claim for use of home, then there might be a proportion of your costs that you are able to claim for. So things like heating, electricity, council tax, mortgage interest, internet and telephone use, for example. But you must be able to provide a reasonable method of dividing those costs. An example might be the amount of time that you spend working from home, or possibly the number of rooms that you use for business, for example. Now, tip number 6 is making sure that where you have co-owned property, so property that's owned by more than one individual or more than one business, that you're apportioning expenses and income correctly according to your legal ownership of that property. Now, if this is not apportioned correctly, then that's going to lead to potentially, again, more tax that you're going to pay if you've entered more income, for example, or less expenses than you could have done. So that's just something to bear in mind as well. Now, number 7 is something that's fairly straightforward, and is something that you should be thinking about in either November or December before January even kicks off. So you want to be making sure that you've got your government gateway user ID and your unique taxpayer reference to hand, because even if you get to the point where you've got all of the information available ready to go to be inputted into your tax return, if you don't have that information ready to go, then you're not going to be able to prepare your tax return. And if you are late with your tax return, then you may incur fees. So you definitely want to avoid doing that. So make sure that you've got your admin together before January. So tip number 8 is make sure that you're not forgetting about the Rentaroom scheme. So the Rentaroom scheme lets you earn up to a threshold of £7,500 per year, tax-free, from letting out furnished accommodation in your home. Now, this is halved if you share the income with your partner or someone else. However, it is a tax exemption that you want to take advantage of if you are renting a room. Now, the tax guidance says if you earn less than £7,500, then you don't need to complete a tax return. However, if you do earn more than this, so £7,501, then you do need to complete a tax return. Or alternatively, you don't need to opt into the scheme at all, and instead you can record your income and expenses on the property pages of your tax return. And you can find out more information about the Rentaroom scheme on the HMRC website. So if you enjoyed today's video, then give the video a thumbs up, consider subscribing as always, and I shall see you on the next video.